Right. Okay. Just a good evening. Good evening to you, Manu. Yeah, cool. So hope you all had your dinner, your wonderful dinner, and then enjoy your the public holiday tomorrow for everybody. Right. So without further ado, let's look into the report for today. Today will be just a bit different, yeah. Whereby I would be doing the what do you call the first half, the fundamental part of it. I will be doing the based on what I would like to share. And the second part of it, I will be doing the live report, because usually Wednesday, by the time this morning, I've already sent out the report to everybody, right? So after sending out the report, nighttime, usually the market has moved considerably also. And furthermore, today, in a short while, we would be seeing the FOMC releasing the details already. Okay, so that's the thing that that's why these are the few things that we need to take into account because of the movement. There's the second part of it. I'll be doing the live charting. Okay, so with that, let's spend a short while with the disclaimer as per the requirement, and then we would be starting this session already. Right. Okay. Now, for the FX events, these are the things that I want to talk about. There are a few things here to discuss today. Now, first of all, right, I think everybody is currently talking about what we call the rate hike probability. This is something important. Everybody wants to know. But the thing is that based on the reports that you have seen so far, all those reports that I've been talking about and presenting to you, especially in the last week, we could see that, that whenever we surpass the 70% mark, the probability is very high that the rules would be following that way. And what we can see from here is that a rate cut probability, the maintaining of the rate at 5% is at 11%. The 5% rate, currently that's where we are. Now, the market expects there's 89% over here expectation that we would have a 25 basis point rate hike, and 11% showing that there's no rate hike. And based on this, I think there will be a higher chance of a rate hike. And like I mentioned just now, anything more than 70%, it is a very high chance we're going to see that rate hike already. And based on this, in the next few hours, we are really going to see that. Now, I think the key point here is that what's going to happen next? What is really going to happen next? That's the most important thing, because it would have been already priced in much earlier on already. Okay, so what's next after this? That's the key point. So the key question here that I think everybody needs to know is that, is the Fed still open to further rate hikes after the 3rd of May? Okay, the rate hike, that means tonight. It's actually the 4th of May instead of the 3rd of May. Now, we need to be clear and understand that there is a lag factor. Whatever that's imposed early on, it won't. You will see the effect of it won't actually come in until a later period, and we have seen that happening in the past few months already. So when it comes to how fast the inflation will drop, the expectation will be different. The expectation of the market and versus the expectation of the Fed, and they seldom come to any confluence. They seldom have the same view. Okay, so I think, if we study the next few things over here, we would have a better idea. Then we can make our own conclusion, which is actually the higher probability, things that's going to happen with a higher probability. So one of the best ways to look into inflation, because the only way that the Fed is going to continue raising its rates is when they think that inflation is going to rise, or is going to stay at the level where they don't think it's going to come down as fast as they hope, they as in the Fed hope. And so because they want it to be down fast, they need to actually do something like raising rates. Okay, so one of the best ways to look into this is actually looking at the 5-year break-even inflation rate, the CPI. This is inflation at the consumer level. The PPI, the producer price index, in short, the inflation at the manufacturing level. And next is the commodity prices. And for this commodity prices, I am choosing a few other, I'm just choosing commodities that directly affects inflation, the easiest one that we can relate to. Okay, so let's look at the 5-year break-even inflation rate first. Now, we have a downtrend, a very clear downtrend coming down since last year. Okay, from April onwards, you can see it coming down, and then June, where we had inflation peaking, also the 5-year break-even inflation rate was also coming down at the same time. As you can see, there's the very consistent downtrend right up until here, where this is where the Fed felt that I think what we have done so far is enough. We have raised rates enough. And what happened next was that, even it went up a bit over here, it started coming down. So this was the Fed doing its part, where it actually reduced the size of the rate hike already, because they were doing that consecutive 75 basis point, 4 consecutive 75 basis point rate hike, and that actually caused the inflation to come down. Now, so what happened next was that they expected it to come down already entirely, and they were very happy, and the Fed was actually celebrating the success of being able to bring inflation down, only to see it spiking up early 2023. And if you remember, at that particular time, we had this news was saying that actually inflation is really it's rearing its ugly head once again, and we're going to see it going higher, and it caused a lot of tension. And the Fed was trying to actually come out and said, okay, we realized that we made a boo-boo, and we are going to continue increase the rates, and we are going to increase way beyond our targets, what we think it should have been, which is the 5%. And they said we are moving beyond that right now. And this is actually what they are doing. They expected this year to only have just 1, maximum 2, but that's a probability we will see much more to that. Okay, so what's happening over here is that when they raise the rates right up here, that increment in the inflation rate failed to even break this high right over here, and it's coming down again. Okay, so that shows that the Fed, the rate increment right here that they have done so far is actually working pretty well. And I do expect that there is a chance that this low will be taken out after tonight, if they have raised the rates for the last time. Okay, those are my expectations, but we will need to wait in the next few hours to see the Fed's decision on that, because based on what we can what we have experienced, the market can always surprise us. There's no such thing as 100%. The probability that you can see of, although since I started the report, we have seen a very consistent data, and any data that's more than 70%, the probability of that happening is just spot on. We haven't had something that's a bit different so far. So we do expect that to continue, but in there, please keep a certain room for the possibility of a surprise. Okay. Now, if you look at the core PCE price index, now this is the go-to indicator for inflation, which currently carry the higher weightage than the CPI when we are discussing about inflation. Okay. So what is happening over here is that if you look at the data here, this is the January data, right? So January we had a 0.3% core PCE price index, and that went up to 0.6% in February, right? And that caused some alarm, whereby one of the this inflation is actually maybe picking up again, and that is like the equal high of the entire 2022, and that caused some concern. So what we have seen so far is that for the last month of April, it's back again to 0.3. This is the data since we got in January. And what is important here is that it's 2 consecutive months we are at 0.3. And on top of that, it is a 50% drop there, a 50% drop. And, so far the worries is unfounded. And if we have, let's say, the month of May, anything less than 0.3, then the possibilities are there that inflation could actually stabilize. But the fact that you have 2 months of equal inflation, core PCE price index, and you're going to experience another rate hike, so there is a high chance that we may see a data something lower than 0.3%. Okay, so we have the PCE over here stabilizing and dropping. Okay, and drop as much as 50%. Okay, let's look into the other inflation data. The next one would be the consumer price index. This is inflation at the consumer level. This is the month-to-month comparisons. So what we have here, we are seeing a drop in value in the last 3 months. We had a negative month for the January, so that was something good for that. And that was also the cause of celebration, for the Fed. They said, it's good. What we're doing so far works, only to see from a negative number jumping -1 to going to positive 0.5. That's a 0.6 jump there. And that really spooked the Fed, because it was the highest in the last 6 months, if you compare to the last 6 months right over here. Okay, so then again, right now with the Fed continuing its rate high, we are seeing a drop, and this drop so far, it's pretty strong right over here from a month-to-month basis is, and if we have next month coming in at 0 or anything less than that, I think that will further strengthen the case that probably this thing might continue to go down, and there's not much cause of worry right over there. Okay, so that's CPI month-to-month. What about the CPI on the year-to-year basis? There you go. Now, what we are seeing over here, this is quite a consistent drop. It is not something that we are seeing 2 months equal. Even right here, there is a slight drop right there. And what I want to discuss right now, right here, is that the 6% drop that we saw in March to April, a 5% drop. This is a 1% drop, and this is the biggest drop so far since the peak that we had in the June, the June inflation data. This is the biggest drop so far that we have seen. So here we have, and remember, I was telling you all the lag factor. This is it. This is the lag factor that we are talking about. So maybe that they have come to a point that the inflation is really dropping. Of course, the banks do help. When the banks are in trouble, they don't have that much free cash flow, and the free money is not easily that available anymore. So of course people can't borrow that much, they can't do much things, money is not moving around in the market, inflation will drop. So this is the lag factor that we are talking about. Okay, and if this continues, it's workable. Now if you see what is the Fed target, we are talking about, let's say, about 2%, let's say somewhere around here, right? So from here to here, right, from here to here, what we have over here is a 3% difference, right? Okay, a 3% drop right over here. So if you divide it over the next 7 months, as long as we see a 0.4% drop or higher every single CPI cycle, we could actually hit 2% by December 2023. Now, of course, the Fed don't expect any what we call changes right over here. We don't expect any changes, right? Changes as in this dropping to 2% by 2023. This is a fact expectation, but the market actually expects this to hit 2%, 3 to 2% by 2024, next year. But that's what I'm saying. From a mathematical viewpoint, if we see anything more than 0.4, 0.4 or more in the next 7 months on a consistent basis, yeah, we could actually hit that 2% right there. Okay, so this is showing a drop right here, right? So that's the cool one. And let's look at the inflation at the month-to-month for the inflation of the manufacturing level. And we are also seeing a downtrend. And the data that we have got so far, a negative 0.5%, it actually equals the January data. So that's something good. If at the manufacturing level is also showing the drop in the inflation, that will slowly translate down to the consumers too, right? So if you see this drop right over here, we have a 1.2% drop in the last 2 months, from right over here to here is a 1.2% drop. And the last time it dropped actually more than 1.2%, that was in August 2022. This guy right over here, right? And that was a drop of 1.6%, right? But then again, the rest, they were still not really a big drop. But I want to highlight there is a surge in the in the rate of change for producer price index already. So if this continues, if we get something less than negative 0.5, wow, you can actually more or less for 3 months, right? More or less, we can say that, okay, this is we probably will see inflation slowing down at a faster rate already. Okay, so far we have seen the 5-year break-even inflation rate. We have seen the CPI, the month-to-month, the year-to-year is dropping also. The PPI is also dropping. Then lastly, the only thing that can push price up, in the future, are the commodity prices. And to talk about that, I want to highlight on 2 particular commodities only. One is energy, the next one is food. Okay, because this two is taken out from the core inflation calculations. But we know very well, if this, you can't run away. You have the energy, which is especially the oil, and then we have food. These two are very volatile data that will play a role in inflation indirectly or directly, directly or indirectly. That's why I want to bring it up also. Okay, so the next one is oil price. Now, if you see from here, this is when the oil price started moving up right here, and at this particular area you had the OPEC Plus announcing that there is going to be a cut in production, okay, because they want to make as much profit as possible to prepare themselves for the recession. And for your information, right, everybody's talking about recession is coming. I won't be surprised if the NBER, that's the only agency in the US that can announce that that the US is already in recession or not inflation, sorry, recession or not. And usually by the time they announce, it's not that they won't announce, yes, the US is in inflation now. They're going to say something like, US is in inflation since when? Okay, and they can actually go back like 8 months in time. And if you remember last year, we had 2 quarters of consecutive negative GDP. That is a technical in recession already, right? They could actually just say that during that time, that was the recession that we were looking at. Although at that time we did not think it was a recession, but after looking at further data, yes, it is a recession. But if you look into detail, we can actually say that the market is in recession, but this is a technical term. But they were in a rolling recession. Rolling here means recession happening at different sectors at different times. But every single sector actually saw a downturn before moving up. Now, previously, we had the technology sector actually coming down, right? And the current cycle, we are seeing the financial sector coming down. So in a way, this could be that rolling recession that I'm referring to, right? Now, one particular way for you to identify how, are we in a recession or not? When we are in a recession, oil prices seldom can push up, because when there is no demand, there is just not enough buyers to prop these oil prices. Now, we saw the OPEC actually announcing that rate cut. That was a big jump right over here. Now, if you refer to the reports, I said, wait for this guy to fill the gap first, then we will see. Now, based on last night when I started writing this report, none of this here suggests that this thing is oil is going to fly. The price action right there. Now, if you look at the oil price right now, which later I'm going to share with you, oil has already dropped more than $5 here. When I wrote here, this was 75.50. It has dropped more than $5 already. So if this thing is meant to go up, right, this thing won't drop. It will just continue because there's demand. China would be buying. Yeah, China is opening up its market. This thing should be going up. Why is it coming down? Okay, because there is no real demand. So you have energy prices dropping. So when you have energy prices dropping, then it won't add into more inflation risk that will be coming in the future. The probability of inflation actually taming down is much higher with an oil price that is coming down. Okay, so the next thing that we need to look at, next one, okay, we have done with the oil. Next one, what is that? Wheat. Wheat represents food, right? A lot of the food in this part of Asia, I understand, is rice, but if you look in general, it is wheat, right? They make, they make breads and stuff like that, food, and then different countries, they use wheat to do different food staples and so on, right? So what we are seeing over here is the prices of wheat is also tumbling. And right now, it is even fast approaching the lows of 2021. And you remember that year was really, really bad, right? Because of the market is just recovering from the COVID kind of thing. And furthermore, if you remember very well, I did an analysis with regards to wheat. Now, Ukraine is one of the largest wheat exporter, and the prices of wheat actually started increasing, right? 1 year ago when the war started. You remember that? And I brought this up saying that, inflation can still continue to rise because right now, food scarcity due to Russia blocking the port of Odessa, so that the wheat from Ukraine can actually come out from there. It's because Turkey and had negotiations in Russia, telling Russia, hey, can you release this because the world needs this food, that Russia agreed to, and this is what you have seen. This is what is happening. So you have oil price is down, you have all the inflation indicators just now showing down, and now you have food also coming down. What is the conclusion, okay, that we have derived from here? And to me, the inflation here is at its tail end, especially if they're going to increase another 25 basis points in the next few hours. Okay, I've put in, we have looked at the indicators and also the two most used commodities which can affect inflation. All of them are showing a downtrend. So the next few hours, if there's a rate hike at 25 basis points, it's probably going to be the last hike of this cycle. And if you look at the probability analysis, after this, there is a higher probability that the Federal Reserve would be maintaining the rate at 5.25% right up until September. That's only if there are no, and I got to stress this, there is no big issue that is going to happen. But the market is always exciting. There's going to be a big one. I'm going to talk about it in a short while, okay? Because I won't discount further hikes, but I'll be surprised if we see one. Now, what are the ways that we are going to see another rate hike coming in? Or what is it? Not rate hike. I don't think there's going to be a rate hike anymore. Let me rephrase that. The market expect that the Fed is going to maintain the rates until December, 5.25% until December, right? But if we see that the US, default is that, which I don't think is going to happen, but because of the arguments between the two parties, the Democrats and the Republicans, so they're going to add stress to the market, and with this stress, everything starts dropping, and it gives more stress to everybody, and then this one, they're going to cut this, the companies, they're going to do more cuts and stuff like that. That adds stress. The Fed may actually cut rate much earlier than September, okay? Or do something extraordinary than what we are expecting it to do. So because what's happening right now regarding the US debt here is that the Republicans has already passed the bill at the House of Representatives to raise the debt ceiling. If I'm not wrong, it's about 1.5 trillion US dollars. Now imagine this. This 1.5 trillion US dollars can only last until April 2024, where the next election is. Okay? It's gonna last that. And the Republicans is doing this on a political thing. It's a political thing. They're gonna say something like, hey, right, you Democrats, you have been accusing us not always want to be slow in raising the debt ceiling. Here we have done it already, but these are our terms if you want it, right? Because they have the majority in the the lower house here, the House of Representatives, of course, they can pass the bill. But the Democrats, they have the majority in the upper house, the Senate. And President Biden is expected to veto this. If President Biden don't veto this, the Democrats will kill this bill at the Senate level, because they are not going to agree to whatever, to the demands of the Republicans. Some of the demands are the COVID money that they have printed must be returned, number one. Number two, the Biden must cancel all the things that he has pushed to. One of the things is the full cancellation of the student debt. The Republicans do not want that, right? So, and many other things. So I doubt that. And the fight between the Republicans and the Democrats is likely going to cause a damper in the market, which, let's say, it's a good thing, because it's going to give us a lot of opportunities to look for quality stocks to buy in the market. Now, I've already said that that's one of the reasons why in my previous report. Now, I think last year, somewhere in June, I gave those that have been following me, I gave a big bunch, recommended, to some companies for you all to look into, to research upon, and gave you all a look into the opportunities, the strength, the weakness, the threat, and all the opportunities that I can see of the various companies. And lately, I think it's the market is going to correct. All those stocks we have made, none of them were losing. All of them were making, and now it's time, because they will come to a point where they have raised the interest rates at 5.25%. There will be probably, when they do that, there will be some hurrah in the market saying, EP, they're not going to raise rates anymore. But then reality will hit, whereby you need to know one thing, that we are in a debt market. Okay, interest rate counts. High interest rates means you have to pay back quite a lot also. So that is going to cause a damper in the market. So that's why, because of that, I expect a correction. Okay, a move down to be coming. Hence, those stocks that you have taken, if you don't want to exit, or exit at least 50% of them and buy later. So that's how you slowly build your accounts too in the first place, right? So with that, these are my thoughts of the market. And so after this, we will be jumping to the charts. Okay.